At this point, you should have completed the core case and compared your work to the answer key. If so, then it's time for a review. So let's start, as always, by taking a look at the prior year tax return. We have a married couple here with a child. So this is one of those cases where you need to use the child qualifying relative tool. This is very straightforward. The child belongs to the parents. So we have some income, $77,000. We have a charitable contribution of $300. Standard deduction of $24,800. Taxable income of a little over $52,000. The tax is $58.54, which is a little over 10%. So the taxpayer is in the 12% marginal tax rate. That means every additional dollar of income would result in 12 cents of regular taxes. We have child tax credit of $2,000. That was the maximum for one child last year, but we know that it's gone up to either $3,000 or $3,600, depending on the age of the child. And the $400, if you look on Schedule 3, Line 7, you see that that is child independent care credit. So there was some child care. So we had some withholding, $5,700. The taxes owed were $34.54. So the taxpayer came away with a reasonable tax refund last year. And that's important to note because if it's significantly different, higher or lower, you want to be able to explain to the taxpayer why there's a difference. As we move through the return, we see the credit there for the child independent care expenses on Schedule 3. And we have a health savings account. So this is pretty straightforward. We have Part 1 is what goes into an HSA during the year, into that account, contributions. And Part 2 is what comes out in the form of distributions. The important lines in Part 1 are line 2, contributions made by the taxpayer or made on behalf of the taxpayer. That's a 0. So the taxpayer didn't contribute anything. Then we have $1,500, line 9, it's $1,500 from the employer. And since the maximum allowable is $7,100 going in, and $1,500 came from the employer, the maximum amount is $5,600 that could come from the taxpayer. So that's a cap on the HSA deduction, which reduces income. But since they didn't put anything in, the taxpayer didn't put anything in, then their taxpayer is not going to get an HSA deduction, is not going to be able to reduce their income. So let's take a look on the distribution. The taxpayer took $1,638 out of the HSA. So a little bit of a decrease because $1,500 went in, a decrease in the balance, although it could have had some earnings. $1,500 went in, $1,638 came out, and the distributions that were for qualifying medical expenses are $1,638. That's not a surprise. That's pretty typical. The taxpayer knows what are qualifying expenses, so the taxpayer only takes out as much money from the account as they have qualifying expenses, because if they take more money out than they have qualifying expenses, that is taxable. As you can see here, the result is there is no taxable income. Let's move on to the intake booklet. First is a scan lines 4 through 11. See if we have any no's. We don't, so that's good. We see there's a dependent for a married couple. That's one of the cases where you don't have to look at the qualifying child, qualifying relative tool, because it's obviously very straightforward. We note the daughter was born in 2017, so she's under 6 as of December 31st, 2021. So she entitles the taxpayer to the $3,600 child tax credit rather than the normal $3,000 child tax credit. On page 2, we're looking for yes answers. There's wages and salary like last year. Interest and dividends, that's interesting because the taxpayer didn't have any of those on the 2020 tax return. So we want to find out what was different this year. Contributions or repayments to the IRA retirement account. Looks like there might have been employer contributions, and if the income's high enough, there's no retirement contribution credit. There wasn't last year. They have medical and dental expenses. Everybody does. Presumably they're paying for those with withdrawals from their HSA account. And they have charitable contributions. We saw $300 last year. We'll see how much it is this year. That's obviously something you ask about. Child and dependent care expenses such as daycare. We saw there were $400 credit in 2020. We'll have to see how much is this year. Documentation is required. They had a health savings account. They still have a health savings account. They got an EIP. You have to ask about that, how much there was. With 3 people, they were entitled to $1,400 times 3 or $4,200. If they got less than that, then they'll get more on their 2021 tax return. And finally, they did receive advanced child tax credit payments, and there should be a letter from the IRS saying how much they got. And finally, a quick scan through the documents. We have some Social Security cards, which is good because they're young. Their taxpayer and spouse are young. They're not going to have Social Security benefits statements. We've got some interest income and a penalty. So this was taken out early, apparently. We have a W-2, looks pretty straightforward. There's code W for the HSA contributions. D, which is typically some sort of contribution to a retirement account. DD is your health coverage expense. That's sort of a memo entry. That's the expense to the employer. So we saw $41,000 there of income, $35,000. So we're in the ballpark. Same amount of income roughly as last year. Here is dependent care benefits. So the employer contributed money toward dependent care. And so the expenses of the taxpayer you can't use expenses of the taxpayer that are paid by the employer as a deduction, as part of your deduction. So 2 W-2s. Here is our HSA, and there's a distribution of $1,850, so a little bit more than last year. And here's a letter from the IRS saying that the Gomez's got $4,200 in EIP. This is helpful, but it is not required. If the taxpayer, in this case, were to say they had gotten $2,800, we would file the tax return and asking for another $1,400, and we would warn the taxpayer that the IRS will do a reconciliation before they send that $1,400 or any other part refund to the taxpayer. So that's going to slow things down. But if they're sure that they only put, in this hypothetical situation, $2,800 into their bank, then, but if they're sure in this hypothetical situation that only $2,800 went into their bank, then again, we do not require this letter. We also have a letter, 2 letters as it turns out, from the Treasury. This is addressed to Eduardo saying that there were $900 of advanced child tax credit payments. And there is another letter for Maria. Why are they doing 2 letters? Because it's a married couple and they split who is getting the advanced child tax credit in half. And if for some reason the parents had separated, then they would start with the premise that each of them had gotten $900 of advanced child tax. So what if the taxpayer doesn't have letter 6419 and they have a child they should have gotten the advanced child tax credit for? First, you want to ask them whether they opted out of the advanced child tax credit or not. You could have done that. They could have done that, but probably most of them didn't. If they didn't opt out, then we can't prepare the tax return until the taxpayer has the 6419 or the equivalent from the IRS. So how do you do that? Well, one option is to go online and get that information. Let's take a look at that real quickly. If you do a Google search on Advanced Child Tax Credit Payment, you will come to this IRS page. Actually, if you do Advanced Child Tax Credit Payment Lookup, that'll get you here, the easiest way to do it. And there's some information, and then it says View Payments, and you click on View Payments. And here's your Child Tax Credit Update portal, which is going to allow you to check, view your payments. You click on View Advanced Payments, and it wants an account with a third-party service called ID.me. This is going to be a problem with a lot of taxpayers. You might want to print this page out for them, and they can go home and try that. You're certainly not going to allow them to put their hands on your computer. Another option is they can call the IRS at the 1-800-829-1040 number. We all know how well that worked last tax season. Or the taxpayer can mail a letter to the IRS and ask that they send out another copy of the missing letter. And if they mail a letter to the IRS, they're going to end up waiting at least 30 days to get the copy. I guess the fourth option is they could make an appointment at a local IRS office, go down and have the 6419 printed for them. So let's take a look at the interview notes. You should have asked about the daycare or the child independent care expenses, and the Gomez's have information about that. We do not need to see a receipt or a printout from the organization. Here's a list of the things that were used, that the HSA withdrawals were used for, the HSA distributions. And over-the-counter medications are allowable this year. And here's that 1099 INT. They cashed in the CD early. They're not telling you any particular reason why they did, except they needed the money. So they're not going to be able to avoid paying that penalty for early withdrawal. And they contributed only $100 this year compared to $300 last year. So their charitable contribution deduction will go down. They mentioned the stimulus payments. They have that letter, and the advanced child tax credit is covered by the letter. So that's it for the interview notes. So as always, you want to enter the economic stimulus payments, the RRC. That's pretty straightforward. And you want to, and you can use under COVID-19 relief, there's an entry right there. You can also use the advanced child tax credit listing there, the default, to go in. And this is critical. You want to say yes, assuming that it's true, because if you don't click yes here, then the taxpayer is the advanced child tax credit is capped at $2,000, which is the 2020 maximum. So that's $1,800. That's the 900 plus 900, one child. So that takes care of the advanced child tax credit entries. So I want to show you another way of getting to the charitable contribution amount other than just going through deductions, itemized deductions. You can go down here to the CARES Act 2020, click Begin, and you end up in a list of charitable contributions, options, and they say, yes, you made some contributions, and we recommend using the override. In this particular case, there's $100, and you click Continue, and you're done. This is actually more useful for the quality reviewer, because the quality reviewer goes down to the CARES Act here, clicks on Edit, and sees the override amount without having to drill down through the menu. So let's take a look at the child and dependent care credit. So under deductions, credits, we click on edit here. And here's our child and care credit. Notice that you can print that if you want to see what it looks like. Anytime you see a little icon here that says print, you have the option of printing a form. So here's the $10,000 that was paid. TaxSlayer knows about the money that the employer provided because that was entered as part of the W-2. Step 2 is dependents. When you look at that, it'll list all the dependents on the tax return, and you pick one. Step 3 is qualifying persons. It's to add somebody who is not on the tax return. You don't generally want to do that. In this case, you don't at all have to do that. Click continue to page 2. And it's pretty much, this page has pretty much information we don't care about. This box is for somebody if the taxpayer was a full-time student or disabled, not the case here. The second one is if the spouse was a student or disabled, which is also not the case here. And then whether the question is, did the taxpayer pay any expenses, child care expenses, for 2020 during the 2021 tax year? And this is no. And finally, there's a question about filing status of married filing separately. And there's a bunch of questions, but this is not a married filing separately return, so we don't care about that either. Let's take a quick look at the health savings account. That's the information that goes into TaxSlayer involves an adjustment because the HSA contributions reduce the income, reduce the adjusted gross income. It does not create a credit that is used to reduce the amount that's owed. So let's take a look at Form 8889. Notice there's no print option. So this has already been created. This belongs to the taxpayer. That is, Eduardo's employer is the one who is contributing to it, and Eduardo is the owner. It is not possible to have a joint HSA. The HSA belongs to either the taxpayer or the spouse, but not both. It's a family policy, family coverage. So that means that family expenses can be used as qualified expenses. So in the core case, there was no contribution by the Gomez's, and they were eligible for all 12 months. They took out $1,851. That's from the 1099-SA form. And they had $1,851 of qualifying expenses. And there's no HSA adjustments. Notice that this is much less rich in terms of the number of lines than the actual HSA form. That's because we're just collecting the information that's not already known to TaxSlayer. This concludes the core case. Please pause the video and turn to the expanded case, tasks 5 through 8. Okay, let's take a look at some interesting aspects of the expanded case. So one obvious change, we've added the baby, Francisco, in the dependents section. And there's a nice note reminding us that the dependent was born in 2021. You have to say 12 months. That's also true for someone who died, a dependent who died during the tax year. You also put 12 months. So if you had a baby who was born and then unfortunately died during the same year, it would still be 12 months. As we can see, looking at page 2 of the 1040, the taxpayer's refund has significantly increased from 2020. It's now over $11,000. That's driven by $5,400 more for the refundable child tax credit. If you take $3,600 for each for the two children, that's $7,200 minus the $1,800 advance child tax credit received. That's how you get to $5,400 more of refundable child tax credit. There's an additional economic stimulus payment of $1,400 because at the end of the tax year there were 4 people on the tax return who were entitled to $1,400, and only 3 of them had the payment had only been received for 3 of them. Finally, there's $3,400 from Schedule 3, line 15. That's the child and dependent care expenses credit for that, $3,400, which is a great deal more than last year. And if we look at Form 2441, you see that the calculation for that $3,400 goes like this. The maximum is $8,000 if there was one qualifying person. That is one person who received care. So even though there are 2 dependents who potentially can have received care, only one of them got that. So we start with $8,000, and the reason it's only $6,800 is because the employer contributed $1,200 toward that. So that gets you to $6,800, and they are able to claim half of that as a refundable credit. For the health savings account, the only change was that $1,600 was entered as an HSA contribution because that was both from the taxpayer and an aunt who contributed, and contributions made outside of the individual taxpayers are deemed to have been made by the taxpayer. So that $1,600 is going to reduce the taxable income. The taxpayers are in the 12% marginal tax bracket, so that $1,600 is worth a little bit less than $200 of tax saving. So let's back up a step. If a taxpayer has a high deductible health insurance policy, and for 2021, the IRS defines that as a health plan with a deductible of at least $1,400 if it's an individual plan, or $2,800 for a family plan. And deductible means basically that amount is you're on your own for the first, in this case, $1,400. If single, this is a family, so they're on their own for the first $2,800. Now, that isn't 100% true because the employer contributed, in this case, $1,500, but that didn't pay the expenses directly. It paid it indirectly by going into the HSA account and then being withdrawn. The real power of an HSA is when the employer contributions either don't cover all of the qualifying expenses, or there are no employer contributions and the taxpayers responsible for all the qualified expenses. And the power here is that when you make a contribution, when you put money into the HSA account, it decreases taxable income. You're in the 10% or 12% bracket, so you're getting 10 cents or 12 cents essentially for every dollar you put into an HSA account. And when you take the money out for qualifying expenses, you do not pay taxes on it. So this is unlike an IRA, where when you make a contribution to an IRA, it reduces your taxable income. But when the money comes out of the IRA, when it's distributed, it becomes taxable income. So in an IRA, you're essentially deferring taxes and letting the money grow tax-free while you're letting the money grow. Whereas with an HSA, you get the advantage of not paying taxes or reducing your taxes when it goes in, the money goes in, and not having it count as income when the money goes out. So obviously, if you know that you have your taxpayer with a high deductible insurance plan, and you know that you're going to have to spend, say, $1,000 during the year, then it really behooves you as a taxpayer to establish an HSA if you don't have one. And if you do have one, it's ideal to put the money into that and then take it back out to pay for it, rather than using cash to pay the qualifying expenses directly. And notice you don't have to you don't have to take out any contributions by the end of the year. They can accumulate. Once you're on Medicare, you can't contribute any further, but you can still pull the money out and use it for qualifying expenses. So a lot of taxpayers who have a high deductible insurance policy aren't going to be able to accumulate money in an HSA. They just don't have the extra money to build up the HSA for a rainy day when they have a lot of medical expenses. But still, if they're qualifying expenses that are at all predictable, then this should be a kind of a slam dunk. They want an HSA. They want to run their money through the HSA in order to reimburse themselves for the qualifying expenses that are allowable. We're not in the position of offering financial advice. That's outside the scope of our program. But if you happen to run across somebody who has some high medical expenses, maybe they have a bronze plan from Covered California, and they don't have an HSA, or you're not sure they do, and you ask and they say they don't, it might be worth taking a minute or two to say there's some real advantages of doing it. This assumes, of course, that the taxpayer actually has enough income to owe taxes. If you're a low-income taxpayer who's the $24,000, or if you're married, or the $12,500 covers your income, you have no taxable income, then reducing your AGI isn't going to help your taxes. But assuming that you've got a taxpayer who owes some taxes, it's probably worth a minute or two to say, hey, establishing a health savings account really could help you by making contributions and then taking it out for qualifying expenses. I think you really should explore that. That's all you need to say, is just a nudge that pushes people in the direction of HSAs. And that's not just a theoretical comment. As health costs continue to increase, employers are more and more turning to high deductible insurance plans because it shifts those increasing health costs onto the taxpayer, onto the employee. And in a lot of cases, the employer is not going to make a significant contribution toward that plan. So we're just going to likely to see more and more high deductible health insurance plans in the future. And finally, let's take a look at the 1099-G for the family leave maternity payments. There's not a lot to say about this other than, oddly enough, it's entered as unemployment. And if somebody had both unemployment and family leave, the form, the 1099-G, would have separate information on those two halves, and you would enter it separately. And be careful when you see unemployment that you don't just enter the top half and go on. You need to do a quick look at the bottom half and make sure there's nothing there. Finally, let's turn to the what if questions. So, what if the Gomez's had taken some money out of their HSA account and used it to reimburse themselves for an expense that wasn't a qualifying expense, for example, swimming classes? How would this be entered into TaxLawyer? Well, it's pretty straightforward. You're going to enter the amount that was withdrawn. That isn't affected by whether or not the money was used for qualifying expenses. And then in the entry for the qualifying expenses, you're just going to exclude that. So if the Gomez's took out, make up some numbers, $2,000, and $1,500 was used for qualifying expenses and $500 was used for non-qualifying expenses, then they're going to pay taxes on the $500. So let's be clear, money is fungible. It really you don't need a one-to-one matching of when the money came out of the HSA account and when it was spent. Basically, you're entering the amount of money that was taken out, and then you're discussing with the taxpayer whether or not they can find qualifying expenses that reach that amount. If they can, that's great. If they can't, then again, they're going to have to pay taxes on the difference. It's going to increase their income. What if question 2? What if Maria, the spouse, had an I-10 and not a Social Security number? How would this change the tax return? So what's an I-10? Individual Taxpayer Identification Number. It's what a taxpayer gets if he or she does not have a Social Security number. So why do you need an I-10? Well, because you worked and you're worked in the United States, you have you have income, and you are required to report that income. And it doesn't matter whether you have a Social Security number or not. So if you don't have a Social Security number and you work, you weren't authorized to work. So why are you reporting taxes? Why are you filing a tax return? Because you're required to by law, and because the IRS never shares that information with anyone else, the FBI, the local police departments, the Immigration and Naturalization Service, the California Department of Franchise Tax Board, none of those agencies are entitled to or get IRS data. So that's one of the things to encourage any taxpayer who's worried that they have an I-10, and if they report the information to the IRS, it'll be used against them. It will not. And there can be significant benefits, as we will see, from filing a tax return, even if the taxpayer or spouse has an I-10 and did in fact work illegally. So we hear more than occasionally, although not that recently, about INS doing a raid on an employer and lots of workers fleeing as the raid takes place because they're not authorized to work. They don't want to be arrested and deported. They're getting a W-2. They're getting wages. They're getting a paycheck. They're on the payroll. They get a W-2 at the end of the year. So how does that work? Well, when you put the I-10 in to TaxSlayer and then create a W-2, it knows that that W-2 requires a Social Security number. So there will be a false Social Security number on that, and you put that in so the IRS can match the income against their records. But the underlying tax return is still based around the I-10 and not the Social Security number. And yes, the taxpayer gave the employer a fake Social Security card. That's not our problem. We are not law enforcement. We are people who prepare taxes. So the quick answer is the tax return for the Gomez's would have looked exactly the same as far as the numbers if Maria had an I-10, except that the third EIP payment except that for the third EIP payment, you had to have a Social Security number to get it. So the Gomez's would have only received $2,800 rather than $4,200 as part of their initial payment. They still would have gotten the $1,400 for the baby. TaxSlayer handles all of that. You just need to enter the information into the software, and it will decide based on whether there's an I-10 or not. And an I-10, I forgot to mention, was what looks like a Social Security number, but starts with a 9. If you have a puzzle about why a particular benefit didn't occur, and you know there's an I-10, it's definitely worth looking at Pub 4012 and the Duck Book to see if there is mention of an I-10 being required. And finally, just a note that the core of the tax calculations, basically page 1 of the 1040, is not affected by whether there's an I-10 or not, because it's basically the calculation of how much taxes you owed, just with adjustments. What really changes or can change is the credits, because those are tailored by Congress as it wishes. And again, the EIP, the third EIP, was only for those who had Social Security numbers, as an example. Question 3, what if Francisco, the new baby, was adopted? How would this affect the ability to do the tax return? Well, there is an adoption credit on the tax return in the tax code, and there is an adjustment for adoption expenses in the tax code, and both of those are out of scope. So we could have done the tax return. We could do the tax return if we wanted to ignore those, but those can be rather significant. So the basic answer is that we almost certainly should not do the return. We should send the taxpayer to somebody who can take advantage of the credit and the adoption expenses adjustment. This concludes case number 7. Gomez, you're ready to move on to case number 8.